October 8th, 2024. It was a Tuesday morning in London that began with the deceptive calm of any other trading session in the precious metals markets. Financial analysts were focused on the usual macroeconomic indicators, the Federal Reserve interest rate whispers, and the fluctuating strength of the United States dollar. But beneath this routine exterior, the plumbing of the global silver market was about to experience a catastrophic failure. In less than 4 hours, a single event would shatter the illusion of stability that had governed silver trading for decades. The catalyst was an order of unprecedented scale and intent. The Central Bank of India entered the market not seeking paper contracts, digital credits, or futures promises, but physical delivery of 1,000 tons of silver. In an industry built on fractional reserves, where silver is often traded in layers of paper obligations, this demand for the actual metal acted like a physical hammer to a glass foundation. When the market tried to find the physical bars to satisfy this requirement, the system choked. The most terrifying indicator of this internal collapse was the explosion of the silver lease rate. Normally, the cost for banks to borrow silver from one another is a negligible fraction of a percent, hovering around 0.25%. On that Tuesday, that rate did not just rise, it detonated, screaming upward to 200%. To put this in perspective for any serious investor, banks were suddenly paying 800 times more to borrow silver than they were just 24 hours prior. This was not a mere market adjustment or a temporary bout of volatility. This was the unmistakable sound of institutional panic. When lease rates hit those levels, it means the largest financial entities on the planet are desperate. It signifies that the metal they have sold, leased, and promised to their clients does not actually exist in their vaults. They were caught in a classic liquidity trap, but instead of a shortage of cash, they were facing a terminal shortage of the physical element itself. As the morning progressed, the contagion spread. The sudden realization that the physical silver market was effectively empty sent shockwaves through the derivative desks in New York and Chicago. For years, critics of the silver market have warned that the paper-to-physical ratio was a ticking time bomb. On October 8th, we saw the first fuse light up. This event marked the beginning of the most violent rally in modern commodity history, as silver began its ascent from $29 an ounce towards $75. While the public remained largely unaware, the insiders knew. The era of cheap, abundant paper silver had just ended. This was no longer about speculation. It was about survival in a market where the physical truth was finally catching up to the paper lies. To understand why the silver market is currently disintegrating, we must look beyond the price ticker and examine the architectural fraud of the modern exchange system. For decades, the global financial elite have operated under a principle known as fractional reserve bullion banking. In theory, when you buy silver through an exchange-traded fund or a futures contract, you are purchasing an interest in a physical asset. In reality, you are likely holding a digital ghost. The London Bullion Market Association, or LBMA, and the Comex in New York are the two pillars of this system. According to recent data, there are now 408 paper claims for every single physical ounce of silver held in registered vaults. Let that number sink in. If every person holding a silver certificate or a digital position suddenly demanded their metal at the same time, 407 out of 408 investors would be left holding nothing but a worthless piece of paper. This is the definition of a systemic house of cards. The mathematics of this imbalance have reached a breaking point. Throughout 2024, we witnessed a historic drain on available inventories. Comex and LBMA stocks collapsed from 290 million ounces at the start of the year to just 210 million ounces today. This represents a 27.6% drop in available supply during a period where the price of silver more than doubled. In any healthy market, high prices attract more supply to the market, as holders look to book profits. In the silver market, the opposite is happening. As the price climbs, the vaults empty faster because the owners of physical metal realize that the currency used to price it is losing its credibility. We are seeing a massive migration of silver from the west to the east, moving from transparent bank vaults into private, unallocated storage and sovereign reserves. When silver leaves the LBMA system, it rarely returns. This is what insiders call the Great Decoupling. The paper price on the screen is increasingly becoming a fiction, while the physical price, the price you must pay to actually get a bar of silver in your hand, is detaching into a realm of its own. The system functioned as long as no one asked for delivery. It was a game of musical chairs where the music never stopped. But the India order on October 8th was the moment the music died. When a sovereign nation demands 1,000 tons of physical metal, they are not interested in a cash settlement or a rolled-over contract. They want the atoms. The banks are now discovering that they cannot satisfy the physical demand by printing more digital contracts. You can print $1 trillion with a single keystroke, but you cannot manifest a single ounce of silver out of thin air. The ghost in the vaults has been exposed, and the 407 people who do not own the bar are about to find out the hard way. The crisis we are witnessing is not merely a result of supply and demand, it is a mathematical execution of the world's most powerful financial institutions. For years, a small group of elite banks has dominated the silver market by maintaining massive short positions. To be short means to bet that the price will go down, or more accurately, in the case of these banks, to use massive paper sell orders to suppress the price and keep it artificially low. But in 2024, the predator became the prey. According to the latest Commitment of Traders report from the Commodity Futures Trading Commission, 5 unnamed United States banks are currently holding their largest short position in 8 years. These institutions are short exactly 194.43 million ounces of silver. In the past, whenever silver began to rally, these banks would simply dump thousands of paper contracts onto the exchange, creating a synthetic supply that crashed the price. This time, the physical buyers did not flinch. The math of their failure is brutal and transparent. Silver started the year at $29 an ounce. As of today, it has reached $75. That is a price move of $46. When you multiply $46 by their short position of 194.43 million ounces, the result is staggering. These 5 banks have lost over $8,943 million in less than 12 months. This is what is known in the trading world as a short squeeze, but on a global systemic scale. Every time the price of silver rises by just $1, these 5 institutions lose another $200 million. They are bleeding capital at a rate that would threaten the stability of even the most liquid balance sheets. This is not a theoretical loss. It is a realized disaster that requires constant margin calls and the liquidation of other assets to cover the mounting debt. The question the market is now asking is, how long can they hold their breath? When a trader loses this much money, they eventually hit a point of forced liquidation. They are required by regulators to close their positions, which means they must buy back silver to exit the trade. But since they are buying in a market with no supply, their own buying pressure sends the price even higher, causing even more losses. This is a feedback loop of financial destruction. One of these banks is already broken. The liquidation we saw in October was the first domino to fall. The remaining 4 are now trapped in a burning building with no exits, and the fire is being fueled by every industrial manufacturer and central bank currently competing for the remaining physical ounces. The financial world operates on a code of silence when it comes to institutional failure. Regulators and central bankers know that a sudden announcement of a bank collapse can trigger a systemic bank run. This is why we have not seen a headline naming the victim yet. However, the evidence of a silent liquidation is written all over the market data from October and November. When a massive short position of the scale we discussed is forced to close, it leaves a permanent scar on the price chart and the exchange volume. On November 19th, something truly extraordinary happened on the Comex. In the middle of a record-breaking trading day, the exchange suddenly went dark. Silver futures trading was halted for 6 hours. The official explanation provided to the public was almost insulting in its simplicity. A data center cooling issue in Chicago. They claimed that excessive heat required a total system shutdown. For anyone who understands the infrastructure of modern high-frequency trading, this is highly improbable. These facilities have triple redundancy and cooling systems designed to survive a hurricane. What actually occurred was a digital heart attack. As silver spiked above $73 that morning, the risk management algorithms of at least one major bank hit their absolute breaking point. These systems are programmed to automatically buy back contracts to prevent infinite losses. This triggered a cascade failure. The more the algorithms bought, the higher the price went, which triggered more buying. The The price was headed toward $100 in a matter of hours. If the Comex had not pulled the plug, multiple major financial institutions would have been insolvent by noon. The 6-hour halt was not for a cooling fan, it was for a regrouping of the elite. During those hours, phone calls were made between the Treasury, the Federal Reserve, and the heads of the major bullion banks. They needed to find a way to liquidate the failing bank's position without destroying the entire market. When trading resumed, the price had been artificially suppressed back below $70, and the massive buy orders had mysteriously vanished. This was a controlled demolition of a trading desk. One of the 5 major shorts was effectively removed from the game. But the problem with a silent liquidation is that it does not solve the underlying shortage. It only hides the symptoms. The metal that the bank owed still does not exist. The other 4 banks watch their peer go under and realize they are next. We are currently in the eye of the storm. The public is being told that the cooling systems are fixed and the market is stable, but the internal ledger of the global silver market shows a massive, gaping hole where a Tier 1 bank used to be. The countdown to the public announcement has already begun. While the banks are struggling with digital contracts and margin calls, the entities that actually handle the physical metal are making even more drastic moves. In late November, the industry was rocked by an announcement from Metalor Technologies. For those unfamiliar with the name, Metalor is a Swiss-based giant and one of the largest precious metals refiners in the world. They have been in operation since 1852. They have survived the collapse of empires, 2 world wars, and every major economic depression of the last 170 years. Metalor did not just announce a quarterly loss or a reduction in staff. They announced that they are completely exiting the silver trading market until January 2026. This is a total shutdown of their silver operations for over 14 months. When a company with that much history and specialized infrastructure walks away from a core business, it is not a cautious decision. It is an act of industrial surrender. The reason for this retreat is simple but devastating for the global economy. Metalor has realized that they can no longer source physical silver at the prices quoted on the paper exchanges. As a refiner, Metalor sits in the middle of the supply chain. They buy raw material from mines and scrap recyclers, refine it to high purity, and sell it to industrial users like Apple, Samsung, or solar panel manufacturers. This business model depends on a stable spread between the buying and selling price. However, the gap between the paper price on the Comex and the actual cost to obtain physical metal has become an unbridgeable chasm. When Metalor tries to buy silver for their clients, they are being asked to pay massive premiums that are not reflected in the official spot price. If they fulfill their contracts at the agreed-upon rates, they lose money on every single ounce. If they raise their prices to cover the physical premium, their clients point to the lower paper price on the screen and refuse to pay. By exiting the market, Metalor is telling the world that the official silver price is a lie. They would rather let their massive refining facilities sit idle and lose 14 months of revenue than participate in a market where physical reality no longer matches the financial data. They are waiting for the system to break and reset. When the world's most experienced refiner refuses to trade, it is a signal to every industrial manufacturer that the supply chain is no longer functional. The silver is not just expensive. For those without direct mine contracts, it is becoming non-existent. In the shadows of the official financial reports, a new kind of arms race is taking place. This is not a race for missiles or territory, but a desperate scramble for the critical elements of the 21st century. While Western media remains fixated on stock market fluctuations, sovereign nations are executing massive direct purchase deals that bypass the traditional Western exchanges entirely. The most significant of these occurred in late 2024 and continued into 2025, led by the government of South Korea. South Korea, a nation whose economic survival depends on its dominance in semiconductors, high-capacity batteries, and renewable energy technology, recently executed what insiders call the largest ghost supply deal in modern history. The South Korean government, acting with strategic foresight, went directly to the Shanghai Gold Exchange and negotiated a purchase valued at $76 billion. This was not a trade made for speculative profit. It was a move to secure the industrial lifeblood of their nation. The impact of this single transaction was immediate and profound. According to data from the Shanghai Gold Exchange, This move drained over 1,000 tons of physical silver from Shanghai vaults in just 3 months. To put that in perspective, that represents 2/5 of the entire available inventory in one of the world's largest metals hubs, wiped out by a single buyer. When one nation removes 40% of a major exchange's stock, it sends a clear message to the rest of the world. The window to secure physical supply is closing. Why would South Korea commit $76 billion to silver right now? The answer lies in the projections for the clean energy transition. The International Energy Agency estimates that by the year 2050, solar panel production alone will require between 85 and 98% of current global silver reserves. South Korea is a peninsula with almost no natural mineral wealth. If they do not lock in their supply now, their multi-billion-dollar manufacturing plants for Samsung, LG, and Hyundai will become hostage to whoever controls the remaining stockpiles 10 or 20 years from now. But South Korea is not alone. We are seeing a pattern where central banks, which have spent decades accumulating gold, are now quietly pivoting to silver. China has already taken defensive measures, implementing a strict ban on silver exports to ensure their domestic industry is protected. These sovereign players have realized that in a world of infinite paper currency, the only true security is the possession of finite physical resources. They are no longer willing to trust the paper promises of London or New York. By moving their wealth into physical silver held in their own sovereign vaults, they are preparing for a world where the official price matters far less than the physical availability. Silver is unique in the financial world because it possesses a dual identity. To an investor, it is a precious metal and a hedge against inflation. But to the global economy, it is an irreplaceable industrial commodity. While you can choose not to buy gold if the price becomes too high, the modern world cannot choose to stop using silver. It is the most electrically and thermally conductive element on Earth, a physical property that makes it the literal nervous system of our technological civilization. The most aggressive driver of this demand is the global transition to green energy. According to the World Silver Survey 2025, industrial fabrication has hit a new all-time high, exceeding 700 million ounces for the first time. The solar photovoltaic sector alone now consumes nearly 30% of all silver produced annually. Every solar panel installed from the deserts of Nevada to the rooftops of Shanghai requires silver paste to conduct electricity. Even with intense efforts toward thrifting, the process of using less silver per unit, the sheer volume of global installations is overwhelming any savings. The European Union alone aims to deliver at least 700 gigawatts of solar capacity by 2030. This is not a luxury, it is a mandated infrastructure commitment. Beyond energy, the automotive industry is undergoing a silver revolution. A traditional internal combustion engine vehicle uses about 15 to 28 grams of silver. In contrast, a battery electric vehicle requires between 25 and 50 grams. This means every electric vehicle rolling off the assembly line essentially doubles the silver requirement of its predecessor. By 2027, EVs are forecast to overtake traditional cars as the primary source of automotive silver demand. When you add the massive infrastructure for 5G telecommunications and the explosion of artificial intelligence data centers, which require high-performance computing hardware, you begin to see why the demand curve is vertical. The crisis deepens when we look at the supply side. We have now entered our 5th consecutive year of structural supply deficits. In 2024, the market was short by 148.9 million ounces. In 2025, that deficit persists at approximately 117 million ounces. The fundamental problem is that silver supply is inelastic. Because over 70% of silver is produced as a byproduct of mining copper, lead, and zinc, companies cannot simply mine more silver just because the price is high. They would have to build entire new base metal mines, a process that takes 7 to 15 years. The industrial world is now in a death grip. Manufacturers are no longer just worried about the price. They are worried about the physical availability. We are approaching a moment where a solar company or an electronics giant will be forced to halt production not because they lack labor or capital, but because they lack a few grams of silver. In a world of digital printing and paper promises, the physical reality of mining and geology is finally asserting its dominance. You cannot print the atoms required to power the future. To understand where the price of silver is headed, we must look at the long arc of monetary history. For thousands of years, silver and gold were the twin pillars of global wealth. From the Roman Empire to the founding of the United States, the relationship between these two metals was remarkably stable. For most of recorded history, the gold to silver ratio held steady at approximately 15 to 1. This means that 15 ounces of silver could purchase exactly 1 ounce of gold. This ratio was not an arbitrary number. It reflected the physical reality that silver is roughly 15 to 19 times more abundant in the Earth's crust than gold. However, in the 20th century, and specifically after the end of the gold standard in 1971, this ratio was distorted by the massive expansion of the paper-silver market. By 2024, the ratio had stretched to an absurd 80 to 1. This means silver was trading at a massive historical discount relative to its yellow counterpart. If we take today's gold price of approximately $4,530 and apply the historical 15 to 1 ratio, silver should be trading at $302 per ounce. At $75, silver is not expensive. It is actually one of the most undervalued assets in the history of finance. We have seen this kind of tension break before. In 1979, the market experienced a violent reversion. Led by the Hunt brothers, who attempted to corner the physical market, the price of silver exploded from roughly $6 to nearly $50 in less than a year. The gold to silver ratio collapsed toward 20 to 1 almost overnight. While the Hunt brothers were eventually neutralized by regulatory changes, the lesson remained. When the paper market loses control of the physical supply, the price does not just rise, it teleports to a new reality. The current situation is far more explosive than 1979. Back then, there were no solar panels, no smartphones, and no global electric vehicle fleet. Silver was primarily a monetary metal and a component in photography. Today, the industrial demand is an order of magnitude higher, and the available above-ground stockpiles are at record lows. In the 1970s, governments held billions of ounces in strategic reserves. Today, those vaults are mostly empty, sold off during the decades of price suppression. We are now witnessing the beginning of a great reversion. As investors and central banks realize that gold is becoming increasingly inaccessible for the average person, the rush into silver will accelerate. History tells us that silver is a high beta version of gold. When gold moves, silver runs. If gold continues its ascent toward $5,000, a reversion to even a 30 to 1 ratio would put silver at $166. This is not speculation, it is a return to the mean. The current price of $75 is merely a pit stop on the way to a valuation that reflects silver's true scarcity and its absolute necessity in the modern world. As we move into the first quarter of 2025, the silver market is bracing for a new type of pressure, the institutional tidal wave. While the previous months were defined by industrial panic and bank liquidations, January represents the moment when the big money of Wall Street, the pension funds, insurance companies, and sovereign wealth funds must rebalance their portfolios for the new year. This is not a matter of choice, it is a matter of fiduciary duty and performance chasing. In 2024, silver delivered a staggering return of 158%. To put that in perspective, the S&P 500 grew by approximately 24%, and gold saw a healthy but much smaller gain. For a portfolio manager, missing the best performing asset class of the year is a professional disaster. When these managers conduct their quarterly reviews in January, they see a market that is outperforming every traditional asset by a factor of 6. This creates an irresistible pull for capital, often referred to as the fear of missing out, at an institutional level. The problem for these institutions is that they are trying to enter a market that is already physically exhausted. Most of these funds have hundreds of billions of dollars in dry powder or cash reserves specifically allocated for alternative assets. If even a tiny fraction of that capital, say 1%, tries to buy physical silver, the math becomes impossible. There are currently only 210 million ounces of available inventory in the combined Comex and LBMA vaults. At $75 an ounce, the entire available Western silver inventory is worth only $15,750 million. A single large hedge fund or a mid-sized sovereign fund could theoretically buy every single available ounce and still have cash left over. This is what analysts call too much money chasing too little metal. In January, the algorithms that manage these massive funds will begin their buy programs. These programs are designed to hit specific allocation targets, meaning they will continue to buy regardless of whether the price is $75, $85, or $100 until they reach their desired position. They are not looking for a bargain, they are looking for exposure. This institutional wave will hit at the exact same time that the 4 remaining short bank positions are at their most vulnerable. As the new buying pressure from pension funds hits the tape, the price will naturally rise, creating further losses for the banks. This is the ultimate liquidity event. The unnamed bank that liquidated in October was the smart one because they got out before the January wave began. The others are now facing a wall of institutional capital that has the power to drive the silver price into the triple digits in a matter of weeks. When the smart money and the big money collide in a market with no supply, the result is always a vertical price move. We are standing at a crossroads in financial history. Everything we have discussed, the explosion of silver lease rates to 200%, the $9 billion bleed of the major banks, the retreat of century-old refiners like Metalor, and the aggressive sovereign hoarding by nations like South Korea, points to a single inescapable conclusion. The era of the paper promise is collapsing, and the era of physical reality has returned with a vengeance. As we conclude this analysis in late December 2025, silver has already shattered all-time records, surging past $75 an ounce. This represents an annual gain of over 150%, making it the best-performing asset class on the planet. But for the serious investor, the price on the screen is not the most important number. The most important number is the quantity of physical metal you actually control. The final warning is this: the window of opportunity to position yourself is closing at a pace that few appreciate. We are moving toward a market condition known as no bid. This occurs when the gap between the paper price and the physical availability becomes so wide that the paper price effectively ceases to exist. You may see silver quoted at $80 or $90 on your phone, but when you call a dealer to buy, you will hear 2 words: out of stock. Or worse, you will be asked to pay a premium of $50 over the spot price for delivery months in the future. The 5 major banks that are still trapped in their short positions are not just fighting a market trend, they are fighting the laws of physics and geology. They cannot print the silver required for solar panels, electric vehicles, or sovereign reserves. One by one, these institutions will be forced to liquidate, and each liquidation will act as a booster rocket for the silver price. When the news finally breaks that a Tier 1 financial institution has failed due to silver derivative exposure, the resulting rush will make the current rally look like a quiet warm-up act. History does not repeat, but it often rhymes. We are seeing a rhyme of 1979, but with the added pressure of a global industrial revolution that cannot function without this metal. You have seen the data. You have seen the institutional panic. The choice now belongs to you. Will you be among the few who understood the warning signs and secured their wealth in tangible, irreplaceable assets? Or will you be among the millions who watched from the sidelines, waiting for a better entry point that never came, only to realize too late that the most important commodity of the 21st century had simply run out? The countdown is over. The silver squeeze is no longer a prediction. It is the defining financial reality of our time.